Okay, welcome to our next chapter, chapter 21, financial analysis and decision making. So let's take a look at our first section here. We're going to talk about investment decisions. And we know that decisions on behalf of organizations and companies in relation to investments are important for several main reasons. The first reason is really the large amount of resources that may be tied up in different projects. And making decisions about large amounts of expenditure, whether or not it's on capital equipment or perhaps expanding into a different country, these are key decisions for all businesses. I guess linked into that, decisions going wrong can cost a company a lot of money. Abandoning a project or abandoning an investment of some kind, perhaps an overseas sub, perhaps a project that's going wrong in relation to a new product, can be extremely expensive. So these decisions for the board and indeed for the company and the shareholders, given the necessity for long-term shareholder wealth maximization, are absolutely key. These are the biggest decisions that perhaps companies have to make. So in terms of methods that will be used, you'll be familiar with the different types of investment appraisal methods from your past studies. A word of comfort here, the detail to which we need to go into for the SBL exam is limited. I think for our purposes, all that we need to know is the basic calculations in relation to the investment appraisal methods and indeed the basic underlying assumptions. It may help, in fact, to know broad limitations, and they're not overly difficult to gauge. So let's take a look at the first area, accounting rate of return. Now, certainly in real life, this wouldn't be a method that is used on a regular basis. We know the calculation, we're talking about average profit, in effect operating profit between two periods of time, and indeed over and above that, the average investment, so the average amount of assets sort of tying up the carrying amount. Now, several problems with this. The biggest problem is obviously that we are including within this sort of formula, as it were, albeit for the fact that it's not straight sort of net profit, we're including non-cash items, and indeed for decision making, particularly decision making obviously that it involves the future, the idea of including cash items of expenditure really doesn't work that quite well. The other key point obviously is the time value of money. With all investment decisions, it will be involved future aspects of inflows and indeed outflows, and the idea of not including some sort of adjustment for the time value of money really undermines this particular technique. So in essence, it's not really a great technique for the long term because of the greater risk associated with long-term investment decisions. In terms of payback, perhaps a little bit better. I mean, what payback tries to do, as you'll see here, is sort of answer these questions, in terms of the time for an investment to pay for itself or indeed to cover costs or possibly to break even. So in essence, we're talking about initial outlay, setup costs, possibly early costs, and indeed the amount of time. Now, albeit for the fact that, that information is useful for an investment decision that may involve millions and millions of pounds, it doesn't provide enough information. So as a simple example, when we take, let's say, a payback period of 3.5 years, we're effectively ignoring any cash flows after that point. The biggest concern, probably a bit like the ARR above, is the time value of money. Now, there is the option, obviously, to build in discounted payback, but still, even with discounted payback, we still have this issue of some cash flows, albeit for the fact that they're forecasted, being ignored. So, the key point here is, yes, it's useful to a point, but it's overly simplistic, even if we build in the discount element. The internal rate of return, we know, is a popular technique, and indeed, linked into, my apologies, net present value is next. Net present value is the go-to technique. Absolutely across the board. It's more favored by examiners, certainly the SBL examiner, and it's definitely more favored in real life, along with, to a lesser extent, IRR. So what are we talking about with NPV? We're simply talking about future cash flows. We're talking about cash flows out and cash flows in, and coming to terms with some form of NPV. If it's positive, we go ahead. If it's not, then we don't. So it's a fairly straightforward technique. It can be complicated by perhaps the cost of capital, using the right one, and also by tax implications or scrap values, etc. But the bottom line is that this is an attempt to forecast forward in terms of all cash flows in and out, and indeed over and above that to make a decision based on using a discount rate of some kind. Now, in terms of the advantage, clearly it focuses on cash flows as opposed to non-cash items. Certainly time value of money is built in there as a result of the use of the discount factor, and indeed the risk. Note that we can adjust the risk or adjust the discount factor depending upon whether or not this particular project has a different sort of risk profile than perhaps our normal work. Outside of that, it's an absolute measure. And indeed, it certainly includes the value of equity, or the impact of the value of equity. Okay, and it's probably, well, not probably, it is certainly the method most closely associated with shareholder wealth, or the maximization of that. In addition to that, on the flip side, certainly changes in the discount rate can cause fairly significant changes, as you will know from your former studies. And in addition to that, clearly any investment appraisal technique is going to be based on uncertain forecasts. So therefore, we're at the mercy of the person who is forecasting the cash inflows and indeed the cash outflows. Now, next link technique, I guess, is IRR. This would be sort of certainly favored by the examiner, but less used in practice. We're talking about the discount rate that produces an NPV of nil. Now, again, you will have seen this in your former studies, and I think key points here are not dissimilar to the NPV area, in the sense that certainly cash flows are relevant, which is great. In addition to that, the time value of money. Now, over and above that, the idea of being able to come up with a discount rate that provides us with a nil NPV is particularly useful, because then we can adjust the discount rate and make decisions around the project. The problem is that IRR as a sort of a technique in itself is not completely bulletproof. You'll be aware from your previous studies that you can be put in this situation where, particularly where cash flows are uneven, rather than having outflow followed by inflows, where you can end up with more than one IRR and several other areas as well. So, in terms of the real core detail on IRR, not overly relevant to the SBL exam. I think for our purposes, let's just understand what it does as per the definition, and indeed the link between IRR and NPV. Okay. Now, there's several techniques. I mean, they can be used certainly to make a decision at the outset in terms of moving ahead. They can also, obviously note, be used to support decisions about abandoning a project. The problem, as we said up top, in terms of having committed resources to a project and then abandoning it, is that numbers may say one thing, but practicalities may say something else. It may be very difficult to follow the numbers, as it were. Okay. Let's move on to the next area of risk and uncertainty. Now, we'll know again from our former studies how important these areas are to investment decisions. So, if we're relying on forecasts in any way, shape, or form, then certainly there are going to be risk and uncertainty in play. Exogenous variables, variables that we have no control over, are going to be included in the financials, in our numbers. So let's make sure that we know the difference between the two. Risk, basically, we can put some sort of value on it. In other words, broadly speaking, probabilities are known. These outcomes have probabilities, and we know them. Now, in terms of uncertainty, they're not. Now, there are some techniques that we can use, possibly, scenario planning, etc., sensitivity analysis. But at the end of the day, there's a big difference between those two things. We can't quantify uncertainty in any way. That makes projects that include that element so much more difficult to assess. Okay. In terms of managing risk, how can we manage it in an investment sense? Well, we could choose short payback periods, but we know the problems with just simply relying on payback issues. Outside of that, if we do our research in terms of those variables, in other words, the things that we think are most likely to change or most sensitive to change, perhaps we can get closer to reality. Sensitivity analysis, as I've mentioned, is certainly a way to minimize not just risk but also uncertainty as well. And indeed, outside of that, possibly a risk-adjusted cost of capital, and I mentioned that up top in relation to different projects having different risk profiles. So we can adjust certainly the cost of capital to reflect the sort of increased risk, let's say, that we see in this particular project. Okay. In terms of tax and financial reporting implications, note, as I mentioned up top, that certainly tax can complicate investment decisions, and particularly when we think about a sort of a substantial NPV or IRR calculation. But here we're talking about the sort of general implications for listed companies. And certainly, from a tax perspective and indeed a reporting and financing perspective, board of directors need to have a good fix on capital expenditure and the impact of that capital expenditure on financial reporting and indeed the accounts. Now, in terms of capital expenditure included within a project, clearly, from an accounting viewpoint, we know how capital expenditure is dealt with, broadly speaking, capitalized NCAs, etc. And from the tax side, it works slightly differently in terms of capital allowances. When we think about investment decisions, remember, we're always looking for cash flow figures, so we would have to be including, let's say, cash tax-related figures in an investment appraisal rather than just ordinary figures. In terms of the mode of financing for particular investments, it depends on the circumstances. As we can see here, several options. If the money is borrowed, then we may well have an interest element. If it's internal equity finance, slightly different. If we're a listed company and we're looking to get finance from outside the company, again, slightly different. So a number of options, broadly debt v equity in that sense. In terms of the tax, as mentioned up top, tax can complicate investment decisions quite considerably. The tax on the returns. We know, as just mentioned, in relation to capital expenditure, that there will be capital allowances or tax allowable depreciation, of the equivalent of. And indeed, outside of that, certainly where we're using debt, as mentioned, then there may well be an interest element or interest tax on interest saved as a cash flow within the investment appraisal project as a cash inflow. Okay. Let's move on to the next area of this. This is assessing performance. Now, in terms of the SBL exam, a bit like one or two of the areas here, the emphasis on financial analysis or ratio analysis, if you will, is not significant. What I mean by that is it's highly unlikely that we're going to have to analyze, let's say, a set of accounts or analyze a substantial number of numbers. And we'll see when we run through the ratios just down below, ROC, gross profit, etc., that I've extracted one or two here or there. But I think the likelihood of us having to do a fully blown analysis is slim. Now, in terms of measuring performance, what are the objectives? Well, certainly, a business exists, generally a for-profit business, to achieve its overall objectives. So we measure performance, obviously, to gauge our performance against those stated objectives. In essence, performance measurement is part of our control system. We're controlling our results, our actual results, against our targets and indeed our objectives. Now, in terms of how we might do that, several measures, as you'll pick up. I haven't taken each one out of the study hub. I think that all of these you'll be familiar with from your past studies, obviously return on capital being one of the biggies. If I was going to do a financial analysis or a ratio analysis on a given company, I'm inclined to go for what I call the big numbers. In other words, the big numbers in the accounts, and indeed the big numbers within ratio analysis, with this being the first one, I guess, the return that, let's say, equity holders are making on an after-tax basis. And indeed outside of that, obviously in terms of capital employed, we need to know how efficient we have been in effect turning our capital employed into profit before interest and tax. So let's remember the detail of the formula, but the chances of us being able to ask to go into detail on something like this, I think, are slim. In terms of profit margins, we're familiar with profit margins within a straightforward set of account. I just picked out gross profit. You'll be familiar with operating profit and indeed net profit margin. We should be able to look at a set of accounts and have a feel for anything that is perhaps moved year on year. And when I mentioned big numbers, this would be the area that I'd be thinking of, indeed with all of the ratios, but where you're looking at gross profit margin, there should be no significant reason why profit margins move year on year. And if there is, that's the sort of area that you want to be investigating. Next area here, sort of linked to the above, or that we're linking to revenue here, the idea that we're looking at revenue v capital employed, the amount of revenue that we're able to generate. And again, it's a good comparative ratio year on year in terms of just our efficiency of using the capital that we are employing. Another key one, I've just picked out the current ratio liquidity. As I've said elsewhere in the course, cash is king, and a company's liquidity is key to its existence. In particular, its ability to meet its short-term liabilities, i.e. current, with its current assets, i.e. cash, accounts receivable, etc. I mean, generally speaking, as a sort of a rule of thumb, you would want something in the area of 2 for 1. In other words, 2 current assets, 1 for current liabilities, but obviously it varies from industry to industry. We have an industry that perhaps doesn't offer credit, it's going to be slightly different, or one that's heavy cash based, it's going to be slightly different. But broadly speaking, a 2 for 1 ratio. And we know that the quick ratio would just take out inventory or stock from the above, so it gets even more tight, as it were. Now, in terms of gearing, certainly an important topic area for us. We've got to get a fix on both of the ratios, not overly complex. And we know that gearing is essentially, to some extent, a sort of a measure of risk. Obviously, we can see the calculation, but the higher the gearing level, to some extent, again, we're generalizing, the more we would be concerned about the company. Okay? And linked into gearing, obviously, interest cover. We should expect to see, if we see increased debt year on year, we should expect to see an adjustment in this figure in terms of interest cover. Interest will be going up, and indeed profit will be going down. So again, these two areas draw attention to concerns over risk. Now, in terms of investors' ratios, these I see as less of a priority for us because you don't see them coming up too often. The one that I would draw out probably is the area of sort of dividend payout ratio. Easy to spot within the exam. We're simply talking about the ordinary dividend and indeed the profit after tax with preferred dividends coming off this. This is an important ratio, certainly for listed companies and for shareholders looking at the decisions made by the board in terms of what is being paid out. This is essential, obviously, in terms of a shareholder's decision as to what they do with their shares. I'd also draw your attention to, total shareholder return, TSR. Remember how to calculate this. This is one that we see from time to time in the exam as well. So investor ratios for me, outside of the two that I pointed out, not as important really as the sort of bigger numbers. For example, profit ratios, gross profit, ROCE, current ratio, etc. Okay. In terms of the non-financial area, we're familiar with the concept of non-financial performance indicators becoming more and more relevant, particularly over the last 10 or 20 years. So in essence, what we're saying is there's not enough information provided by financial measures. Now, obviously, the solution to that clearly is perhaps profit growth over more years or using non-financial performance measures. Now, linked into that is this whole area of KPIs, and we'll see when we come down to the balanced scorecard that looking for KPIs and indeed CSFs, or being able to come up with them, is an important skill. So what do we mean? Well, basically we mean areas or metrics that are based on critical success factors. And again, you've seen this phrase in your past studies. We're really talking about things that need to go right for the company to be successful. Just taken from the Study Hub, we're talking about competitive performance. In other words, if they are satisfactory, it's highly likely that we're going to be competitive. So really these two things are linked, the KPIs and the CSFs. So be aware of the definitions and be aware of the link between the two. One is linked to the other. KPIs linked to key or critical success factors. Now, in terms of potential problems, really, perhaps, we don't choose enough, or perhaps we choose too many. Getting the balance right is important, and the more people with expertise involved, the better. Okay. Outside of that, when we think about things like non-financial performance measures, certainly with some, I wouldn't say all, but with some, they may be easier to calculate and indeed to understand. In addition to that, NFPIs can be wrapped around the organization or what the organization does, the industry, the company. And over and above that, generally speaking, it's more difficult to manipulate, to sort of be creative in this area. Whereas with financial measures, whether it's profit or ROCE, etc., there are ways in which creative accountants can manipulate the numbers, that's for sure. In terms of quality, we know what quality means, and we know how important quality is, particularly nowadays, to businesses. In terms of the difference between sort of quality control and assurance, quality control might be considered to be the sort of traditional approach to quality. The idea of sort of measuring quality and comparing this to a standard. So in other words, producing a batch and then getting that batch, inspected, as it were. So, in terms of assurance, slightly different and more sort of in line with perhaps some Japanese manufacturing practices. In the 80s, Toyota, lean, and et cetera, et cetera. The idea of, making quality a sort of a way of life. In other words, trying to hone procedures which guarantee quality rather than producing and then inspecting. Things like quality meetings or circles, if you will, where staff are involved. It's really making the whole idea of quality the center point of the business. So note the difference between control and indeed assurance. In this next area, we talk about the balanced scorecard. Now, we mentioned this up top in terms of the non-financial performance indicators. This is a core area and an important area within the exam. Perhaps one of the most important areas, certainly within this mind map. Really, what we're talking about here is Kaplan and Norton's model, which provides a manner or a way for us to consider areas of the business, really, that are important outside of the traditional performance measurement areas. So Kaplan and Norton, in effect, are suggesting that any business should define CSFs and indeed KPIs in these four areas. And indeed, each of those four areas, the KPIs, CSFs, etc., should be driven by the vision and the strategy. So everything should stem from the mission, vision, and strategy and should be linked to that. We shouldn't be choosing measures that are irrelevant in terms of mission, vision, and overall corporate objectives. Now, in terms of the detail here, I mean, obviously having a scenario in front of you makes it easy because every scenario is different. But in terms of, internal business processes, we're simply talking about the myriad of different processes that will exist in any given business. And we're talking about, things like processing time or booking time, etc. So, in other words, play what you see on the pitch if you're asked to come up with metrics, and invariably it won't be more than one or two. In terms of learning and growth, the go-to one here for me is always something along the lines of training or training budget or training costs, training year on year or comparison. What you could also consider here is probably sort of new products. With the idea that we're trying to devise metrics that show that we are learning and that we are growing year on year. If we're spending double the amount this year on training than we did last year, then that sounds good. In the same way that if we launched no new products last year, but two this year, again, this is good. In terms of the customer perspective, probably the most important one out of the four, here we're talking about how the customer perceives us. So really let's ask them. We're talking about, surveys, feedback. We really want to get inside the customer's head and, try to get a feel for how do they feel about how we're doing, our product, our service, etc. So this is very much about sort of communication and getting a feel from customers as to their view. And the final one here, financial, this is really just more of the same. Really, all that we're saying under the financial perspective is, yes, let's measure financial areas, but let's also measure each of the other four. So here we'd be looking at the standard stuff, ROCE, profit margins, etc., etc. Now, one or two issues in relation to the balanced scorecard. Clearly, to bring in non-financial performance measures must be a good idea because it allows us to sort of gauge important areas of our business that just simply using the financial perspective doesn't. Okay, but the problem is balance. It's balance between the two. It may well be that one perspective is sort of contradicts another. We may be looking to increase net profit margin or increase operating profit, but that could be affected by investments that we make in new products or training, etc. So the bottom line is that the balanced scorecard isn't perfect. The measures may conflict. It's also time consuming to come up with metrics and indeed suitable metrics in each of the areas. And indeed, over and above that, we've got to make sure that if we were to introduce something along the lines of the balance from all levels of the business, otherwise it's going to be a waste of time. Okay. So that concludes chapter 21. I hope that you found that helpful. In terms of key areas there, for me, not so much the detail on the ratio analysis or financial analysis side, the ratios, etc., but more to do, I think, with the investment appraisal techniques, particularly the big ones, NPV and indeed IRR, but I think that we probably have a reasonable fix on them anyway. Over and above that, certainly the whole area of KPIs, understanding what they are and that they're linked obviously to CSFs, and a reasonable understanding of the balanced scorecard. I think with the scorecard, the most important thing is not so much rote learning straight from the study hub. It's finding questions where the examiner is asking for, let's say, KPIs in a given scenario and seeing how you do against the model solution. That's the key, being able to come up with relevant KPIs with a given scenario. Okay, many thanks for listening. I hope you found that helpful.